And welcome to Margin Points. Today we're going to be discussing 3 essay topics that I'm writing on today. We're going to talk a little bit about what I'm finding interesting, some different ways I'm thinking about them, what's making the cut, and what I'm still wrestling with. So today's topics are AI procurement, AI pricing, and the shoe shine index. And we'll be talking a little bit about why maybe at the outset I'm looking at these things and why I'm going deeper on them, what I think is interesting. So one of the first things you'll obviously notice is today I've got 2 different AI topics that I'm looking at. They're related, but pretty separate actually. One part of this I think is just generally in the zeitgeist. We've got the SpaceX IPO coming up. There's a lot of activity around both Anthropic and OpenAI filing confidentially for their IPOs, and the Fable launch, which we talked about yesterday, coming from Anthropic. So I think that just a lot around that, and I think there's some pretty interesting dynamics that are starting to take place now that are foreshadowing what's to come in the AI space and how to think about some of the economics. One of the big drivers, actually, if we start with the first topic, is AI procurement and what that starts to look like. I was reading a newsletter from Ramp that Ramp put out, where they actually go through some of their spend data that they have from different Ramp customers. And one of the things that they pulled out was looking at some of the top AI token spenders and what they were doing with it. And I saw, okay, there's actually a lot here. Some of the top Ramp AI, kind of what they called most AI pilled spenders, are spending somewhere around $7,500, so $7,500 per month per employee. And that's kind of the baseline for an organization that is using Ramp and that is really deploying pretty heavily and using a lot of tokens. So I think that kind of formed the basis of, okay, how are we thinking about those numbers and where they could go in the future? And starting to see this dynamic of actually having companies have a major cost center around AI token spend, right? So just after salaries, okay, is that kind of that second big bucket that comes in? And I think Bobby's got a great point just about Ramp's data being pretty telling. I think if you know what you're looking for in it, there's a lot there, and it definitely something that I'm looking at when they drop new information, because it's kind of hard to get up to the moment spend info on that. So that kind of led me down the rabbit hole of really thinking about kind of what a procurement agent would look like for AI tokens. And in today's essay, I'm working on kind of exploring that. And that was really the first topic. So noticing that there's kind of this paradox starting to develop with the AI foundation model companies and how they're actually developing these models. And some of this really came from playing around with Fable a little bit more, the latest offering from Anthropic, and just feeling like, okay, as the models actually get more and more powerful, you can see that as a user, you start to actually be a little bit more disconnected from them. And some of the more jagged edges have been smoothed out, which is interesting from a procurement perspective because it actually allows for more easy substitution. And so some of that, some of the paradox really is like, the better the models are, the less you actually care about which underlying model it is, and there's maybe some more convergence around that. And so kind of playing that forward, that is a model that I've kind of seen play out in the procurement world, right? Where you actually have people that are kind of thinking about, okay, how do we buy? How can we kind of be most efficient with our spend? In some of my background, I've actually seen that play out in like the telecom build out. So as you're building out 3G networks or 4G networks with infrastructure spend, there can be gaps in terms of like who has the highest quality network equipment. Is it Sony Ericsson or Nokia or Huawei or some of those other players, for example? But as there is some convergence, you start to get into kind of much more of thinking about efficiency and what can actually be substituted there. And so just thinking about those sorts of dynamics plays out. And the idea that you could actually have a procurement agent playing around with this that would be able to balance a lot of the requirements for the organization. So basically, kind of taking the kind of more simple concept. Yeah, I think you're totally right, Bobby. Like taking model routing, but actually going quite a bit further, like taking Open Router and saying like it's not just about which model it goes to on any individual request, but looking at this actually more holistically from the organization and saying, okay, what are we really trying to achieve here, both in terms of like whether it's our customer support or it's our core product, depending if you're a software company or otherwise. How do you kind of establish a baseline of where you are to be able to improve that token spend and that efficiency? And it's not really just a cost savings aspect of it. And I think this is the key distinction between like where traditional procurement was versus where this could go. Traditional procurement was so much more around cost savings, and like people see procurement come into an organization, the first thing they think is like, oh, everybody's tightening their belts, like I might be next on the chopping block, and like that's a natural instinct. But here I think it's kind of more narrow in the sense of, okay, like you're looking at a token budget, you're looking at that kind of saying, not how do I minimize costs, but like how do I maximize the value that I'm actually getting out of it. And you could see some pretty wide creativity, let's say, off of a AI procurement agent and how it was actually tasked with it. So, whether that was minimizing, some of the human oversight that's necessary for it, or, really trying to achieve very specific organization objectives, I think it could bring in this kind of new phase of procurement that really has been neglected here in the software world, other than maybe some of the larger publicly traded software companies that have this. And I think a lot of this is colored by the token maxing phenomenon that we've all seen and kind of gone through, where like it's like a hero's journey if you spend more tokens. I think seeing a lot of that play out now gives a different color to kind of the concept of smart spending within AI. And I think there's an element here of like contract length that's playing out. One of the things we've seen and we've written about previously was the changing length of SaaS contracts. So really just seeing that SaaS contracts have gotten shorter and shorter, and probably would continue to, as different enterprises want to maximize their option value and be able to swap things out or replace things with AI. And so if that trend continues for it, that could be pretty interesting here, where there's actually more value from a AI procurement agent that can really assess these sorts of different offers, play different people off of each other, or otherwise, and really have a deeper understanding of what the organization is trying to do for it, and then actually execute, whether that's through harnesses or some of the routers, get that visibility on the spend and help make sure that there's kind of enforcement all the way through it. So I think there's a lot here. My sense is, as I'm netting out on this, and this is actually a great opportunity for startups in the space, just because kind of the nature of an AI procurement agent, you wouldn't really want one of the major vendors doing that work for you, right? Like you'd be skeptical if you were using an Anthropic procurement agent to assess Anthropic's own spend. There's going to be bias built in there one way or another, certainly if it's successful. So I think having something that's a neutral party, a Switzerland, if you will, for AI procurement, I think is an interesting prospect from that. So I think that's interesting to kind of see how that comes together. But I'm kind of expecting there's going to be more on this pricing and procurement element, and really trying to think to see. Some of this is signaling, of course, from the enterprises that are buying in on the tokens, is really just showing like, hey, we're not profligate. We're not the ones with like the leaderboards here where we're just like trying to spend as much and token max as much as possible. But we have some discipline, and this is where like the interesting application of procurement AI starts to be interesting, right? You can imagine a public company CFO saying, hey, we're doing this, we're working with AI procurement agents. It starts to signal in some sense, hey, we're trying to be rational about spend, but we're doing so in a way that like is fine if we actually spend more and we raise and we kind of find the optimal amount of token spend for our business at this given point, and not just think about it as kind of a cost saving move. So yeah, I'm kind of expecting to see a lot of this start to develop, but I'm just as Chad is saying, I haven't seen an AI procurement agent that's really laser focused just on that and not trying to build like a whole procurement suite or otherwise, but really just achieve that objective incredibly well. I haven't seen that, but we'll certainly keep my eye out for that because I think it's an interesting trend to watch. On the next topic, so as well, thinking about AI pricing, there was just a really juicy exclusive story that dropped in the Wall Street Journal last night. And the headline was essentially like OpenAI is looking to drop their AI token prices, anticipating a war for users with Anthropic. Right. And that kind of like war for users aspect like got me thinking. I know there's this effect that I've read about in the past called the Osborne effect. And is basically the concept of the Osborne effect was just taking this idea that, if there is something that is coming soon and you tell the market about it, like in the case Osborne effect, I think it was an older computer company that had this, where if you are announcing that you have a future product, like don't expect anyone to buy your current product while they wait for the new one to come out. Right. And so you see this with kind of like Apple product releases. Otherwise, like you make the release, you want to put it in the hands of people pretty quickly because they're not going to buy your older products while they're waiting. So you want to minimize that time to some degree. But here there's kind of like this weird twist to it, which is instead like we're seeing that OpenAI is talking about lowering prices, and they're actually trying to kind of achieve this thing where they kind of freeze out the market for Anthropic and maybe to some extent for XAI, but really I think pretty targeted on Anthropic to kind of freeze out the market and basically announce to people, hey, before you go signing all these enterprise deals that like we're sure everybody is going to run up in the pre-IPO period, just like wait, because prices are going to come down. So like we'll introduce a little bit of doubt. We'll kind of create a little bit of that sort of uncertainty. And, maybe that'll freeze the market a bit. And I think just seeing that, weighing that type of freeze out moment, it reminded me a little bit of like the Don Draper adage of, hey, if you don't like where the conversation is going, like change the conversation. And with Fable, right, like there's this, oh, wow, like there's a step change from Anthropic. OpenAI doesn't have that right now in the holster. I mean, maybe that's coming or otherwise. But with Fable out there, OpenAI feels like maybe they have this attack vector. What could you say about Fable? Well, it's really expensive. It's about 100 times more expensive than some of the cheaper models that are out there. So there's this like attack vector for it's overpriced, and dropping an exclusive with the Wall Street Journal like makes that a discussion point, makes that out in the zeitgeist. And it actually follows a bit of a trend. I had noticed earlier in the week, I didn't think there was kind of enough there to really talk about, but it ties in. There was a story from Engadget talking about Google's AI Plus subscription that dropped price. I think they halved their price. It was about I think they were at $8 a month for their subscription, and then I think they dropped it down to $5 for kind of like their Gemini subscription suite. So significant to see that from Google, and then of course like OpenAI is like following into that stream and narrative and trying to paint it. In that Wall Street Journal article, it was entirely about this two-horse race dynamic between OpenAI and Anthropic, and like, is this the opening salvo in a price war? So I think there's this kind of like preemptive drum beating here with it. And it also did get me thinking. We had written about in the past and looked at OpenAI's deal with YC startups and the kind of concept of like $2 million of credits. This has some like backdating implications on that of we had said at the time, like, okay, if you're running 60-70% margin on those inference tokens that you're giving startups, it's really like a $600,000 investment in terms of cost for OpenAI. now that reprices higher, probably closer to the 2 million if they're looking to kind of run closer to cost on some of that. So some interesting kind of side implications for that as they move it. And I'm trying to wrestle with, I think I'm going to try to get this clarified a little bit more, but this concept that like really just trying to understand the used car market in relationship to AI pricing. And bear with me for a second here, but I'm really just trying to figure out like used cars form a big portion of the US car market because they provide like cheaper transportation that was great, but isn't just like the latest, greatest model from everyone. And I'm trying to figure out like, is that older versions of AI models that are now just like, they're not cutting edge, they're not frontier? Is this going to be more of a used car market? Or are we going to see, as we see in the car market, like purpose built cheaper cars that are built to kind of be economical right off the bat, like let's say the Ford Maverick or the Slate truck that was announced, that really kind of come in and serve that better purpose at a better value. So I actually, in the essay, I'm really comparing like where the AI pricing mechanism is today and how that compares to kind of the car market and used car market for it as like the cost structure starts to change in there, and seeing kind of some of the lens for that. So going to go a little bit deeper in that area. Yeah, just looking at chat, I think there's a lot of complexity in the pricing models too. Some of that's been simplified and abstracted away for the consumer of like simpler subscriptions, but what I would call like for the more basic builder who's got more simple applications that they want to prototype or get out, some of it can be relatively complex, and really thinking through like, what is my application going to have like a lot of input costs or output costs, and how is that going to price out, and how's that going to work? I still feel like it's pretty early days in getting people's arms around that, and see that. Bobby's thinking, okay, the bigger AI models, companies will eat the lunch of any small companies that try to provide purpose-built smaller models for a lower cost, and open source. I'm not sure I agree with that. I think there's some, I saw today there's a company that launched, blanking on the name, but I did see they're doing, they had a short drop on their launch, and it seemed basically like they were trying to allow you to kind of more easily train an open source model towards your very small specifications, and building out the small model concept. And I don't know how much run you have with that, like how much you can actually get done, but I suspect that as like everybody gets more confident in that, like there might be more applications that pick up in there. I think that's certainly like too early to call on whether some of the big AI models will like, truly own everything in the market, or there might be some opportunities for some smaller, nimbler players to kind of chip around the edges, maybe with more specialized applications with it. I guess moving on to the last topic, the shoe shine index. So I've been thinking about this. This isn't necessarily anything so specific today, but I read in Bloomberg, I think up in the run up to the SpaceX IPO, of course, like reporters are going to try to find people out there that are doing something crazy or a little bit like aggressive with their money to get into the SpaceX IPO. And like predictably, there was someone in Bloomberg that was, basically quoted as saying, "Hey, I tried borrowing money from my friend. I tried borrowing money from my bank, like just to put in more, $5,000 more into the SpaceX IPO." And kind of like unsaid is like, maybe that's not a smart idea, but like, okay, that's out there in the zeitgeist. And I think that sometimes that's presented as like this, what I call the like, shoe shine boy, or like the shoe shine index concept, where, the apocryphal story was like Joseph Kennedy back in 1929, like right before the crash, was talking to a shoe shine boy outside the New York Stock Exchange or on Wall Street. And the shoe shine boy was giving him stock tips, right? And he kind of saw this as like, oh boy, like if that guy's in the market and he's the buyer on the other sides of these trades, like I should be getting out of this for it. And I've been thinking for a while, like you have that concept, and I'm really just trying to figure out like what is the signal that like we should be looking for, because for quite a long time, I think through the meme stock era and everything like that, if you had used the shoe shine boy concept, like literally, and said, hey, who are some people that traditionally wouldn't have thought of like really being in the market and being well informed, um, you would have exited like a million times already, and you would have missed, quite quite a bit about, quite a bit of that appreciation. And so I've really just tried to think about like, okay, if that's not really the signal, like what could be? And the other dynamic that's going on here is index investing. And before, I mean, even prior to .com crash, I think index investing was right around 10% or so of all mutual funds. Then it stepped up to about 15% before the Great Recession. Now it's over 50%. So even the concept, like it's still relatively rare that people are kind of saying like, okay, let me put in large amounts of money into like a single stock. It tends to be, let me put a lot of money into the market and let me buy the index, which in and of itself, I think kind of dilutes or changes that signal. If you imagine, put yourself back in 1929 and the shoe shine boy, instead of telling Joseph Kennedy Sr., hey, I really love SpaceX, he's saying, hey, you know what? I'm going to put some more of my savings into the S&P 500. I don't know that Joseph Kennedy doesn't have a different reaction there, right? Or maybe reads the signal pretty differently. So I think we just kind of have to adjust for what that looks like, especially in an era now where there's so many ways to kind of blindly speculate, or speculate to whatever extent that you have any sort of information or conviction, whether it's 0-day options or certain aspects of prediction markets or otherwise. So there's no real like there's no there's no shortage of ways that you can kind of speculate, where maybe at the time, going back in 1929, there might have been other aspects to that, or there weren't things that were as accessible for, let's say, somebody to easily speculate and kind of feel like they have an opportunity kind of with the market to really make it. But today there's a lot of content out there, whether it's YouTube, TikTok, Instagram. I don't think that the equivalent of just people that we might not have traditionally felt were all that informed about the market. I think they've gotten more informed, and I don't think they're going anywhere. And you need those people to sell to kind of create that crash if there is sufficient volume. And I don't know that that's really the dynamic that like we see here. I looked up to this morning, the current market cap for the S&P 500 is $65 trillion, right? So if you think about the kind of money that we're talking about needing to move quickly to kind of create that type of crash, I think a dispersed population that is, of small investors or otherwise, like might not really create those sorts of dynamics in the same way with it. And, ultimately, like I read the shoe shine boy analogy as Kennedy saw that as, this is someone who shouldn't be in the market. And they are, and that worried him. And I look at it and kind of say, well, actually, like the 33-year-old PR agent that was profiled in this Bloomberg profile that's going to throw $5,000 into the SpaceX IPO. And I should note that this is not investment advice, and this is just for entertainment purposes only, of course. Someone doing that is not, they have a time horizon to invest on. They're the right age, let's say, to be making investments or otherwise. And if they're putting that money into the, S&P 500 index, and that's kind of inflating that to some degree, that's probably not the sort of person that Kennedy would have really reflected on and said, hey, this is like a problem here. And so, yeah, I think the key question is like, who is the modern equivalent of, the shoe shine boy? And I think this one's actually counterintuitive. I think it's actually the boomer. I think it's the boomer. And the reason I think that it's the boomer is I don't think that by and large, the boomer right now should be putting more money into the market at this time. Now, probably they've already, whatever money they have in the market has probably been there for a while or otherwise. They're probably slowly starting to draw that down or manage that as they kind of think about their expenses. And I would get worried, or the thing that I would look at as more a signal is that if that category, which by the way has about 54% of all of the stock assets in America, so roughly $32 trillion, let's say, of the S&P 500 market cap, let's say, would be held by boomers. If you think about that's a much larger pool, right? If they are, instead of kind of withdrawing or just keeping stable as they age, if they're going out and mortgaging their homes to get more juice, or putting more money back into the market or becoming more aggressive as they get older, that would make me start to pay attention. And so that, I think, is kind of where this essay gets pretty interesting, is like it's actually more of a flip over the past 100 years, right? Like 100 years ago, you had the older guy, Kennedy, I think was in his 40s at the time, so not that old, but looking at the shoeshine guy and saying, oh boy, like if young kids like that are in this market, like this is a problem. And now actually, like, we've flipped it totally on its head, where I think younger traders now might say, wait a second, like if somebody is, well into retirement and otherwise and settled with that, and they're doubling down and they're taking money from elsewhere, kind of scrounging up or otherwise to get it into IPOs or in there, I think that's the danger signal. And that's, maybe what we need to look out for. So yeah, I think the Shoeshine Index is interesting in there, and definitely a different dynamic than than had been in the past. Well, great. Thanks very much for listening. It was great to have a conversation today. Next, I'm going to finish these essays off and send them out. So they'll be up on Substack and, of course, our newsletter as well. You can subscribe at any point at marginpoints.com. If you aren't on the list, you'll always get kind of the latest essays as they go out. And you can follow along all of the updates as I publish. Well, thanks, and I'll see you again next time.